We have seen a spectacular rally in the last 3 months. It's taken a lot of people by surprise.
Right.
What factors do you attribute for the markets to rebound, and do you feel it's sustainable also?
India is coming out to be a much resilient and a stronger economy.
Multi-asset or balance advantage? Large caps or mid caps?
Yeah.
Staggered investment? Yes or no? DIIs or FPIs? In large caps, you should be in passives or active? What advice would you give investors who are entering the market? Hello everyone. The markets have seen a dramatic rise after a big fall which we saw when the markets touched the peak of close to 86,000 on September 26th. From there, the markets fell by 15% and they have almost retraced 80% of the losses which we saw till March 15th. Today, the topic is something which I'm sure everyone will be interested, and it's called Gloom, and the spectacular rise of the Indian equity markets. We have seen many events which have unfolded in the last 8 to 9 months, be it the what I call the Trump tantrums, which was over the tariffs, be it the India-Pakistan war, or what we have just recently seen, which was the war between Israel and Iran. Today I have with me Mr. Akhil Chaturvedi. He is the Executive Director and Head of Business at Motilal Oswal Asset Management Company. And with his 20 years of experience, I'm sure a lot of questions as to what we expect from the markets going forward will be discussed with him. So Akhil, we have seen a spectacular rally in the last 3 months. After we saw a 15% cut in the markets from the peak of September 26th. It's taken a lot of people by surprise,
Right.
including us. We were not, we really didn't feel that the markets are really going to rebound so soon.
Yeah.
What factors do you attribute for the markets to rebound, and do you feel it's sustainable also?
Yeah, I think Nilesh, this is it's quite a relevant question today because see the why the markets have broadly rebounded back is that if you look at India versus some of the other economies, India is coming out to be a much resilient and a stronger economy. So if you look at the last quarter GDP numbers, we've clocked upwards of 7%, 7.3% of GDP. We have also seen recovery in the earnings growth in the last quarter, right? So the first 3 quarters of the last financial year, the earnings growth was slowing down, but in the last quarter of the last financial year, the earnings growth, we have started to see some recovery also playing out. So after the corrections, as the economic numbers started to look good and the earnings started to look better, the liquidity part, which was the inflows, continued to be very, very strong. So I think that has broadly given a lot of comfort to investors to come back. And more importantly, I think a lot of mutual funds were sitting on a big cash pile. I mean, almost to the tune of 10% of the total equity AUM was cash. And a lot of managers started to deploy that money early this year, like Jan, Feb, March. So that liquidity coming inside from the mutual funds, plus continuous liquidity coming from the retail investors, and combined with strong growth numbers, earnings growth coming back. And after the cut, obviously the valuation started to look slightly better than what they were prevalent somewhere in August, September of 2024. So that has kind of led to the markets rebounding. And this kind of a situation, if you see over the last 3-4 years, I think broadly India has really done extremely well. I mean, if you see the world is growing at 2%, we are growing at like 6.5%, 7%. Our earnings growth for the last 4 years, literally for the Nifty 50 companies, has compounded at 20%. The mid cap companies have grown at 35%. Small caps have grown at 40% plus. So I think it's a very fundamental rally. I think all the reforms what has taken place over the last 10 years is now yielding some good results, and that gives a lot of confidence, I think, at least for the domestic investors. We continue to lose global investors, but we continue to gain liquidity from the domestic investors. You can just imagine if they come back, what will happen.
Absolutely. No, in fact, one question of mine was that, is this a pure domestic driven rally? Because,
Yes.
we have seen most of the money which is coming through SIPs, retail
Yes.
investors.
Yes.
That space, I just was reading it in the newspapers also. And now mutual fund is the third largest
Yes.
asset
Yes.
class.
Yes.
In fact,
So, yeah, if you look at the total ownership of foreign institution investors in the market used to be at a high of 23%, 24%. They have been continuous sellers over the last 3 years to the tune of 75, $80 billion. And the ownership of foreigners has gone down to 18% now. Whereas non-promoter, non-institution investors ownership was more like 9, 10%, which has gone up to 15%. So, yes, current rally is primarily driven by domestic investors, and I feel that Indians believe in India story more than probably the foreigners believe today. But I'm sure with these kind of macro data which is coming out, and the confidence in the earning story of India, I'm sure at some stage these foreigners will also come back, because I'm sure you would know this, that India's allocation in the MSCI emerging market has actually gone up from 7% to 23%, almost 3x. So it's a matter of time when the global investors will start to look at emerging market by and large, and then within that basket, India with 24% allocation will attract serious capital, right? So that engine of liquidity is yet to play out, which is where I feel that there is enough headroom available for great returns over long term.
One, great thing which you told, amazing thing which you told, and this is something because you and me have been in the industry for more than 20
Yes.
years now, is we used to always go and tell our investors, domestic investors, that, the foreigners have more, confidence than Indians.
Absolutely. Absolutely.
And now I think it's the reverse. I think
Absolutely.
the Indian investors, the domestic
Absolutely.
investors have more confidence than the
Absolutely.
foreign investors.
Yeah.
Do you feel this is sustainable? Because, when we entered this rally, when we actually were at the peak on 25th September, we were talking about there was all this noise going around, and it was true also that, the mid cap, small cap was expensive. Okay. Growth was somewhere where, your quarterly numbers were not, as per expectations. You've seen the markets correct, and now we have retraced almost 80%.
True.
Okay. Uh, do you feel this is sustainable, or what? Or I'll put it the other way. What are the future this thing required, attributes required for this rally to sustain?
So there are two ways to look at this. See, right now the risk for Indian markets is not coming from India. The risk for Indian markets is coming more from outside of India. And there are two large issues. One, this whole geopolitical conflict which is going around, leading to multiple wars, and we have lived a 2-day war ourselves between India and Pakistan. So the geopolitics, obviously, from time and again, it is coming and creating some disruption in the market, or creating volatility in the market. And the other risk is the Trump tariff, right? The double T issue. Hopefully, that should be clearer by the end of this month, because 9 July is the deadline for coming out with some kind of a trade agreement. And I think the noise what we are hearing from Mr. Trump himself and government side is that the conversation is moving more in a positive direction. So if this goes positive, it's good for India. If at all there is some delay, then obviously there could be some amount of volatility. So that's one part actually which is creating more volatility than the India story per se. But yes, if you come down more in terms of valuations, certainly we are not a cheap market. Despite the corrections, the Nifty 50, if you look at the PE multiples, are still, I would say, around the 10-year average mark, and on a trailing basis, on a 1 year, it's slightly discount to the 10-year average. But mid cap and small cap index certainly is trading at a premium. I think mid cap is at a premium of I think 35-40%, and large cap is at small cap is at a premium of 15%. So there is a premium for sure, and therefore I feel that at the headline level, the index might be slightly muted in terms of absolute returns. It could be higher single digit numbers, and probably this is the time where one has to really do a hunt for ideas, hunt for the stocks across large cap, mid caps, or small caps, companies which could still deliver growth and available at a reasonable price. So I think this is a time where investors should avoid to venture out in the market on their own. It could be slightly dangerous, and come to professional managers, and I'm sure they will do their job of searching the gems within probably slightly overvalued market for now.
No, one more thing, Akhil, what we have seen also in this market is when the markets rebounded, you have seen the broader markets have not actually, the advance to decline ratio
Yeah.
has been in favor of declines actually.
Yeah.
So which means that the heavyweights have actually
Heavyweights, some specific sectors like defense is a sector really pulled on especially after the India-Pakistan war, and so yes, some sectors have pulled off, and it actually happens that way. Every time you go through a correction, there will be different sectors which will pull up the market. There would be sectoral rotations, there will be stock level rotations.
And we saw this, if you remember, between 2017 and 19.
Yeah, exactly.
When actually, the market, the Nifty was rising, the large caps were rising.
Yes.
And quality was, it was not a secular rally like what we saw till last.
Yes. Quality actually started to underperform, continues to underperform till date, right?
Absolutely.
So that was a patch when value did very, very well. So companies with the low P multiple, which never went anywhere, like I remember Reliance Industries from nowhere, I think it gave like a 6-7% return from 2007 to 2019, and then tripled up, right? And then all the PSU stocks, they really rallied, and until they also became expensive. I think the current rally, what we are seeing is either in sectors where there is a strong momentum in terms of narrative, like defense. There is a narrative that everywhere there is a war, therefore there will be demand for defense equipments, and India could be one probable exporter in this particular sector. So that keeps that's basically creating the momentum. But otherwise, right now what is working is where actually numbers are getting delivered. So our strong belief at Motilal Oswal is that at this stage you have to be with companies where numbers are getting delivered, which are the top-down sectors, themes where despite flattish earnings growth for the market, you can get decent earnings growth, and those are the opportunities which are still outperforming.
I have some, interesting rapid fire.
That's dangerous.
I'm trying to make it a little interesting.
Okay, let's give it a shot.
So, and you just have to, what first thing comes to your mind.
Yeah.
Right. So, it's you're talking about hybrids.
Yes.
Okay. So, multi-asset or balance advantage?
Balance advantage.
Second is large caps or mid caps?
Mid caps. For me.
Okay.
For investors, both.
Okay. Now, this is a yes or a no.
Yeah.
Staggered investment.
Yeah. Staggered. Is that a question?
Yeah. Staggered.
No, not for me.
Not for you.
No.
Okay. And for the investors?
Investors, I would advise that stagger it out.
Okay. Okay. Now, DIIs or FPIs?
I think for now,
it's where the inflows will come. It's pertaining to that actually in the future.
I firmly believe that we have our local investors are under penetrated. So I'm very, very optimistic on DIIs.
Okay. And the last question is actually an interesting one. Okay. And this is something which I think Motilal will not have issues, but a lot of active fund managers do have.
Okay.
So in large caps, whether you should be in passives or actives?
I would say passives. I would say passives. Yes.
Wonderful. What schemes from Motilal would you actually recommend at current juncture? You have a whole basket.
Sure.
You have you have been one of the first fund house having a passive basket, one of the largest passive basket which you have.
Yeah.
So which are you can say your top 3 funds which you feel in this market, if an investor is coming for a 5-year time horizon. Okay. And which are the 3 top picks of Motilal?
So this is an easy one because as we speak, we have done a brand campaign around promoting flexi cap style of investing. We are advising investors to be in funds where there is a combination of large cap, mid cap, small cap, all three available, because in the current times, a certain proportion of large cap in your portfolio will give you downside protection, and the upside will be provided by the small caps and the mid caps. So in this kind of a category where you have funds which give you exposure towards large, mid, and small, typically you can look at three ideas, which we are strongly recommending. Number one from our side would be the large and mid cap fund. Because as per regulation, at any given point of time, 33% of the portfolio has to be mandatorily into large cap. 33% of the portfolio has to be in the mid cap. The rest 33% is at the discretion of the fund manager, whether large cap or mid or small. The other fund I would recommend is the flexi cap fund, which by the name it suggests that the manager has complete flexibility to go across large cap, mid cap, small cap. Largely at our end, we have about 40% large cap and rest is mid and small. And the third fund, similar nature, is our multi cap fund, which is even more granularly defined by the regulator, where 1/4 of the fund mandatorily has to be in the top 100 stocks. 1/4 has to be in mid cap, 1/4 in small cap, and only 1/4 is available for at the manager discretion. So I would say that choose amongst large and mid cap, flexi cap, or multi cap. This is a good space to be in from next 3 to 5 years perspective, giving you a good exposure across all market cap buckets, and at the end of the day, then trying to give you good risk adjusted return.
So what I can understand is basically not be into funds where your market cap, these are market cap agnostic. At least they have a mix of all.
And on the passive side, since you spoke, I would say that everybody should have one Nifty 500. And we recently innovated. We are the first ones, and we have been first ones to do many passive funds, including the Nifty 500. But we've done the BSE 1000 index. So you just buy this 1000 index, you get 62% large caps. You get good allocation between mid, small, and micro cap. So buy one fund right from the toppest company, blue chip company, right till the 1000 company, which will be the part of your micro cap. So these are also very innovative funds which give you large, mid, small, but still with a larger allocation towards large cap, which in current environment will still give you a good protection.
Wonderful. I think that's something which we have been discussing. And it's better to be in a more multi-cap, flexi-cap, or larger mid-cap kind of a space. Last question, before we call it a day, is what advice would you give investors who are entering the market? The issue with investors is, and I think it's a global psychology. Where March was a great period where people had an opportunity who lost out last year, could have entered. But the conviction was not there because there were this Trump tariffs was going on, and then you had issues on the geopolitical front. And quite a few of them are sitting on cash. Okay, so what advice would you give an investor who now wants to stick his head out and enter the markets?
See, my single point advice to all investors would be to do very careful, spend a lot of time with people like you in determining the asset allocation of their investments or their savings. And once you have done that, you have to stick through it for very, very long point of time. So let's say you have 100 rupees, and if you've decided to put 50 rupees in equity and 50% in all other assets, then continue doing that. But the equity component, if I stick to, is something which for India or India specific is not a 5-year story. It's a 25-year story, right? We are talking about Viksit Bharat. We are talking about 2047 when we will complete 100 years of independence. We are at $4 trillion economy. We were maybe 15th largest economy in 2000 at $200 billion. And in the last 25 years, from $200 billion, we have become $4.2 trillion economy. We are fourth largest. Less than a year, we should be third largest. We'll cross Germany very soon. And which means we have compounded at about 9% dollar terms. If you just extrapolate the same data, what has happened in the last 25 years, which was possibly the not best 25 years, and we assume that next 25 years are going to be better, yet let's look at 9%, our economy will be more like 30 trillion, right? And if the economy is going to go up 5 times, then you can imagine stock markets, which are true reflection of the economy,
Mhm.
come to equities for wealth creation, don't come for returns.
Mhm.
And wealth creation happens only over long periods of time by sticking to it in a disciplined way through asset allocation, and just enjoy the journey, right?
Mhm.
So my advice is asset allocation, and then stick to allocation for for creating generational wealth,
Mhm.
rather than 20% return, 15% return next 6 months, for next one
Mhm.
year. Nobody knows what's
Mhm.
happening next 6 months, one year. We may come and talk whatever we talk,
Mhm.
but markets are supreme in
Mhm.
short term. In long term, it is all about fundamentals. In short term,
Mhm.
it is all about
Mhm.
news, what's
Mhm.
happening in the news, right?
Mhm. No, wonderful with those golden words. I think, thank you, Akhil, for, coming over. And it's always a pleasure talking to you.
Thank you, Nilesh.
Thanks a
Thank you
lot.
for the opportunity.
Thank you.
Cedrus Wealth Partners, orchestrating distinctive wealth management proficiency since 2007. We deliver transparent, unbiased, and comprehensive investment solutions. Today, we manage more than 3,000 crore rupees in assets, proudly serve over 1,000 families and 3,000 individual investors, and with a team of 26 experienced professionals, we help our clients achieve their financial goals. Our 360 degrees wealth management approach integrates investment planning, risk management, tax optimization, and legacy planning. We focus on the 4 essential pillars of financial planning to create a strong foundation for your financial future. Our advisory process is mutually exclusive and collectively exhaustive. We provide uncomplicated advice. No ULIPs, no NFOs, and no structured products. Our portfolio offerings include managed equity solutions for superior risk-adjusted returns, novel offerings including hidden gems that provide pre-IPO and niche investment opportunities, and alternate investment solutions like private equity, real estate, private capital, and multi-index investment strategy. From humble beginnings in 2007, Cedrus has grown with a commitment to innovation, excellence, and trust. With a global presence in key cities, Cedrus continues to redefine wealth management with innovation and trust. Discover the Cedrus difference. Your financial success is our mission. Contact us today to begin your journey.